What is cost accounting? Before defining cost accounting, let's understand what cost accounting concepts really mean. 1. The cost. Cost refers to the monetary value or the sacrifice made to acquire goods, services, or resources. It includes expenses incurred during the production, distribution, and administration processes. 2. The cost object. A cost object is anything for which cost information is collected. It can be a product, service, project, department, or any other identifiable unit within an organization. 3. Cost accumulation. Cost accumulation involves collecting costs related to a particular cost object. This process includes the identification, measurement, and recording of costs. 4. The cost assignment. Cost assignment refers to the allocation of accumulated costs to cost objects based on predetermined methods. This allows for a more accurate assessment of the costs incurred by each object. 5. Cost behavior. Cost behavior describes how costs change in relation to changes in activity levels within an organization. Costs can be classified as either fixed, variable, or semi-variable. And lastly, cost estimation. Cost estimation involves predicting and determining the expected cost of producing a product or delivering a service. This helps management in decision-making and budgeting processes. So, what is cost accounting? Cost accounting is a branch of accounting that involves identifying, measuring, analyzing, and controlling costs associated with the production and distribution of goods and services. Its main objective is to provide accurate and timely information to help management make informed decisions regarding pricing, budgeting, and operational efficiency. What are the importance of cost accounting? Cost accounting plays a critical role in the business decision-making process. It helps management understand the cost structure of the organization, identify cost drivers, and allocate resources effectively. By analyzing costs, businesses can optimize operations, set appropriate prices, evaluate performance, and determine the profitability of products, services, and operations. What are the cost classification? In cost accounting, costs are categorized to facilitate analysis and decision-making. Here are the main types of costs. 1. Direct costs. Direct costs are directly traceable to a specific product or service. For example, the cost of raw materials used to manufacture a product is a direct cost as it can be directly attributed to that specific product. 2. Indirect costs. Indirect costs, also known as overhead costs, cannot be directly attributed to a specific product or service. Examples include rent, utilities, and salaries of support staff. Indirect costs are allocated to products or services using various cost allocation methods. 3. Variable costs. Variable costs change in proportion to the level of output or activity. As the volume of production increases or decreases, variable costs also vary. Examples include direct materials, direct labor, and electricity costs in a manufacturing plant. 4. Fixed costs. Fixed costs do not vary with the volume of production or activity level within a relevant range. These costs remain constant regardless of changes in output. Examples include rent, insurance, and salaries of management personnel. 5. Semi-variable costs. Semi-variable costs, also known as mixed costs, have both fixed and variable components. These costs have a fixed portion that remains constant and a variable portion that changes with activity level. Telecommunication bills, which have a fixed monthly charge plus additional charges based on usage, are an example of semi-variable costs. What do you understand by cost accumulation and allocation? To accurately determine the cost of products or services, cost accountants use different methods of cost accumulation and allocation. 1. Job order costing. Job order costing is used when products or services are unique or customized. costs are accumulated by specific jobs or projects. For example, a custom furniture manufacturing company would use job order costing to track costs associated with each individual customer's furniture order. 2. Process costing. Process costing is employed when products or services are mass-produced or require repetitive processes. Costs are accumulated by cost centers or departments rather than individual units. An example is an oil refinery, where the costs associated with each refining process are allocated across all the units produced during that period. 3. Activity-based costing. Activity-based costing is a more refined method of cost allocation that focuses on activities rather than cost centers. It assigns costs based on activities undertaken within an organization. For instance, a hospital may use activity-based costing to allocate costs related to patient services, diagnostic procedures, and administrative activities. What are cost analysis? Cost analysis techniques provide valuable insights into the relationship between costs, volume, and profitability. Some common cost analysis methods used in cost accounting include 1. Cost volume profit analysis. A cost volume profit analysis helps businesses to understand how changes in sales volume, costs, and prices affect their profitability. It provides a framework for calculating break-even points, analyzing profit margins, and making pricing and production decisions. 2. Break-even analysis. A break-even analysis determines the level of sales or production at which a company generates neither profit nor loss. It helps management determine the minimum sales volume necessary to cover all costs and make profit. 3. Marginal costing. Marginal costing focuses on analyzing the impact of changes in production volume on costs and profitability. It assists in making short-term decisions, such as whether to accept a specific order or shut down a particular product line. 4. Standard costing. Standard costing establishes predetermined cost standards for each element of cost and compares them with actual costs to measure variances. It helps identify inefficiencies, control costs, and benchmark performance. 5. Variance analysis. Variance analysis compares actual costs with standard costs to determine the reasons for deviations. It aids in identifying areas where costs exceed or fall below expectations, and enables corrective actions to be taken. What are the cost control and decision-making? Cost control techniques are essential for managing costs effectively and optimizing performance. Cost accountants employ various strategies to control costs and make informed decisions. 1. Cost control techniques. Cost control techniques include budgeting, cost reduction efforts, cost monitoring, standard cost setting, process improvement initiatives, and the implementation of cost-saving measures. 2. Cost reduction strategies. Cost reduction strategies involve identifying and implementing initiatives to reduce costs without compromising product quality or service levels. It includes activities such as renegotiating supplier contracts, improving operational efficiency, and eliminating waste. 3. Cost-based decision-making. Cost accounting provides essential information for cost-based decision-making, including product pricing, make or buy decisions, product mix optimization, discontinuation of unprofitable products, and investment appraisal.